Hi there, this is Alvin from Dr. Well. We are into another week and I'm going to give you a new stock screen for this week, and it's based on Buffett's factors, okay? And what are these factors? It is based on a paper which is titled Buffett's Alpha, written several years ago, but it's highly cited, highly quoted paper where the researchers broke down Warren Buffett's style of investing into investing factors, right? Factors like value, factors like quality, etc., etc. Okay, so essentially what they found is that there are three factors. One is low risk, one is cheap, and one is high quality. Okay, so these are the three that were being discussed in the paper, and there's actually an additional one which is leverage, because Warren Buffett does have an insurance float that he can tap into, and therefore it helps him leverage on his position, right, by about 1.7 times. But we are not going to apply leverage, so therefore we will focus on these three factors. Okay, low risk, cheap, and high quality. So how do we then use that as a screen? So when we talk about low risk, usually finance world, they define risk as volatility. High volatility means higher risk, low volatility means lower risk. And one of the way that we can compare the volatility is against the S&P 500 index. Okay, so if and the measurement is known as beta. Okay, so the beta is 1 for the S&P 500. If the stock is more volatile than the index, then the beta of the stock will be more than 1. And if the stock is less volatile than the index, then the beta will be less than 1. Okay, so in this case, what I did was I screened for beta between 0 to 0.7. Okay, so I give a bit of discount. So generally, these are the low beta stocks, or in other words, the lower risk stocks, okay, based on the definition. All right, so that was the first screen criteria that I used. And the second is to screen for quality. In this case, I use a combination of it. So the first is I used Novi Marx's discovery of this factor known as gross profitability. The higher the gross profitability, the higher the quality of the stock. And it's based on gross profit divided by total assets. Okay, so that's what gross profitability metric is all about. And I filtered for at least 25%. And this 25% is based on the cutoff for the top 20% stocks in the universe. Okay, so anything that's above 25% by gross profitability, they are the top 20% or the cream of the crop. So that's how I get the 25%. And I also wanted positive earnings as well as positive free cash flow. Okay, they should be positive, but just in case. So I added that two filters in there. And the third thing was to have a white mode rating. This is more of a qualitative analysis, and I leverage on Morningstar to give me the mode rating. It's something that's available directly, so I use it for convenience. So these are the quality criteria that I have used to filter the stocks. And the third one is value, which means to buy stocks that are cheap. Again, I use something that's available, which Morningstar have this star rating for the stocks from 1 star to 5 star. Okay, so for 4 to 5 star, it means that the stock is trading at a discount to its fair value based on the valuation from Morningstar analysts. And 3 stars means it's fairly valued, and 1 to 2 stars means it's overvalued basically. Okay, so if you want to look through the list, you should look for 4 to 5 stars, right? Those are the more viable ones. Actually, at 3 stars, I think it's still okay, especially for high quality stocks. Paying a fair value is fine, right? Just don't overpay for it. After I applied the filters to the US stocks, I got just 25 stocks. Okay, I narrowed it down to just 25 stocks, and yet these 25 stocks are not all buyable, right? Some of them are 1 or 2 stars, some of them are 3 stars. Based on the Morningstar star rating, and only 11 are considered cheap, right? So slightly less than half, but I think that is something that is a workable list for people to look at. So I'm going to give you this list for free, right? The link is in the description box. You can just click on it, give us your email, and we'll send this complete list to you, and you can filter it whichever you want. Okay, so another thing to note is that I also focus more on the market caps. Okay, the bigger market caps, I rank them based on market cap, and I choose the top ones, right? The reason is because it's not that I want the small caps. I would love to, just that the Morningstar mode rating is not available for a lot of the smaller caps. So they are all concentrated on the bigger caps, and that's how I ended up with more well-known companies. And it is not a bad thing, because I guess most investors will find more confidence in these names, right? These 25 names. And I also did some back testing on the portfolio, right? So too bad I cannot like go back in time like 10, 20 years ago and find which are 4 star, 5 stars. Okay, so I cannot add in the consideration for cheapness in the stock. Okay, so I'll just assuming, right, you formed this portfolio 10, 20 years ago. Okay, so there's a bit of that forward-looking bias, right, because we are using current data and we backtest. Okay, so that's not the way that we're supposed to do it. But again, due to the limitation of data availability, right, so this is the next best thing I'm going to do, right? So this portfolio was tested against the S&P 500 from the period of 2009 to 2024. And investment of $10,000 would have grown to $100,373. Okay, so that's the exact number. And for the S&P 500 ETF, it will have grown that $10,000 to $80,927. Okay, so that are the differences. So indeed, this portfolio deliver a higher return, but that's not the important thing, right? Because one of the key aspects of Buffett's portfolio or Buffett stocks, they are relatively more stable than the overall market. Okay, because of that low beta, the low volatility nature, and I think that is an important consideration because we all know that stocks are very volatile, and it usually makes a lot of investors very uneasy, and they give up when the stock has gone down too much, and that causes them to lose money. So when the portfolio of stocks are more stable, I will believe that investors will have more confidence holding them, right? Especially during periods of volatility, they realize that portfolio is not as volatile. Okay, so that gives a lot more assurance to investors. So I wanted to point this out to you in terms of the risk measures, right? So yes, the annual return was about 15.95% per year, while S&P was about 14.36% per year. Okay, so these are fantastic returns. But on the risk side, right, standard deviation, the higher it is, means that the fluctuation of the stock would also be higher. So you can see the Buffett Factors portfolio is about 13.61%, which is lower than S&P 500 of 15.21%. And the worst year in the period from 2009 to 2024, we can see that the worst year was only down by minus 32%, minus 0.232%, less than 1%, while the S&P 500 was down 18.17% for its worst year in about 1.5 decades. Okay, and the maximum drawdown as well for the Buffett Factors portfolio was down about 19%, while S&P 500 ETF was down about 24%. Okay, so Buffett Factors also have a higher Sharpe ratio, higher Sortino ratios. So all these ratios, when it is more than 1, typically the risk-adjusted returns are also higher, right? So therefore, this group of stocks based on this criteria do have some advantages, right? It delivers high returns at lower risk, basically. Okay, so that is essentially what we wanted to when we model Buffett's factors based on all these criteria. So far so good, right? So this is another pictorial comparison for you to see clearer. Okay, so the blue bars are the Buffett factors and the light green ones are S&P 500. So you can see, especially in 2022, that was where the worst year happened. S&P 500 was down 18%, but the Buffett factor portfolio was only down minus 0.32%. Okay, so that is the significant downside protection that these 25 stocks had for over this period of time. And lastly, this is also the year-by-year return, right, in numbers form. And I just wanted to highlight in the sense that although yes, the downside is low, okay, but you can also see that some years the upside is lower than S&P 500. It's less exciting, right? If your downside is lower, usually your upside is also limited to a certain extent. So you can see in 2024, the portfolio is going up 6%, right? Compared to S&P 500 was up 15%. So some investors, the greedier ones will feel that, hey, I'm underperforming, this portfolio is not good, right? But this portfolio is built with stability in mind, and there will be years that it will underperform, especially when the market is very, very bullish, okay? So it will go up less, right? But when the market is bearish, it will go down less. Okay, so you can see the stability works on both sides, right? You cannot have the stability on one side and enjoy the upside volatility in this case. Okay, so the whole is fair. So the same can be seen in 2023, right, where the portfolio was only up like 3.6%, but the S&P 500 was up 26%. Okay, so we can see that these 2 years, the overall market has been very bullish, driven by the AI theme. But the Buffett factors will definitely avoid the AI, right? Because even Buffett himself doesn't buy into AI anyway. Okay, so you can see there are some compromise when it comes to the stability of the portfolio. But all in all, there are also years that it did outperform, right? One year to highlight was 2019, it was up 34%, while S&P was up only 31%. 21.5 is another case, right? The portfolio was up 25. The portfolio was up 23%. S&P was up about just 1%. Okay, so you give and take. There will be some years they will underperform. Some years they will outperform. This is where I believe that the investors' patience, that investors' conviction in the methodology would comes in handy. Okay, so no matter what investment strategy you do, right, it's going to be like this. Some year you win, some year you lose. Okay, it's about sticking to sound investment philosophy over a long period of time. Then you can reap the long-term returns. Okay. Anyway, look at the list. I'm going to send it to you. The link is in the description box. Click on it, leave your email. Hopefully you will be able to find some investment ideas, and you can feel free to use some of the screening rules that I've explained in this video as well. Give me a thumbs up, subscribe to the channel, and I'll see you in the next one. Goodbye.